I'm Eileen Fine, Managing Director, International Tax, National Tax Services, and this is PwC's Tax Insights in Brief. Treasury and the IRS on April 24th released final regulations regarding the definition of domestically controlled qualified investment entities under Section 897. The final regulations primarily affect foreign persons that own stock in a qualified investment entity, or QIE, that would be a U.S. real property interest if the QIE were not domestically controlled. The regulations finalize portions of the proposed regulations published on December 29, 2022. The final regulations generally maintain the approach of the proposed regulations with some modifications. A domestically controlled QIE generally refers to real estate investment trusts, or REITs, and certain regulated investment companies, or RICs, that primarily hold U.S. real property. Gain realized by a foreign person on the disposition of an interest in a domestically controlled QIE is excluded from taxation under the Foreign Investment in Real Property Tax Act, or FIRPTA. In order for a QIE to be domestically controlled, less than 50% of the fair market value of the QIE can be owned directly or indirectly by foreign persons. The proposed regulations introduce a domestic corporation look-through rule for purposes of determining the foreign ownership percentage in a QIE, and required a QIE to look through a domestic corporate owner if 25% was owned by foreign persons. The final regulations increased the threshold from 25% to 50%. The final regulations also adopt a much-needed transition rule, which generally ensures that the regulations do not have retroactive effect. Historic structures are generally exempt from the domestic corporation look-through rule for a 10-year period, provided they meet certain requirements. The final regulations are effective starting April 25, 2024. Portions of the proposed regulations addressing the Section 892 exemption were not addressed by the final regulations, but will be addressed in a separate rulemaking. The transition rule may help alleviate the effect of the final regulations. However, the requirements of the grandfather rule will likely limit their applicability to entities that are not looking to acquire material assets prior to the sale of the REIT stock. Taxpayers that conducted a DC QIE analysis treating a U.S. corporation as a non-look-through person under the proposed regulations should revisit their analysis to determine the impact of the updated look-through threshold per the final regulations. For more details, please read our insight. Thanks for watching. This has been PwC's Tax Insights in Brief.